Hi everyone, welcome back to Interesting Investments. Today we're taking a look at Big Tech Week. Big Tech Week was actually 2 weeks ago, but I'm bad at making videos, so you're getting it now. We're taking a look at the earnings and reports from Amazon, Google, Meta, and Microsoft. And as always, big disclaimer, I own all 4 of these companies, so I am biased. I try to keep it to a minimum, but as any investor, if you invest in the company, then you obviously have a more positive outlook. If you invest in things that you don't have a positive outlook on, I question your decision making. But anyway, let's get into our first company, which is Amazon. And they had a strong earnings report despite the economic conditions, which makes me rather confident that they're going to have a pretty good holiday season this year. Amazon earned the revenue of $143 billion in the last quarter, up 11% year over year. Operating income was up to $11.2 billion, up 343% year over year. And while a 343% increase year over year sounds absolutely fantastic and kind of ridiculous, well, that's because it is. You kind of have to be careful when CEOs and CFOs give these reports, because they often ignore facts like they basically had no operating income this time last year because of spending. It's the equivalent of Bitcoin bros holding a single dollar of Dogecoin and waiting for it to 10x and turn into $10. But I'm not trying to discredit Amazon here, I'm just saying the 343% is a bit exaggerated. Hopefully it is a sign that moving forward, Amazon will maintain a certain level of profitability, rather than its mood swings between extreme capital expenditures and random spikes in profitability. But as Amazon turns into a more mature company, it's good to see them actually turning a profit, hopefully a regular recurring one. And as always with Amazon, AWS was a large revenue driver, up 12%, which is pretty strong growth considering they are the cloud leader. That being said, Microsoft is growing faster and is catching up at a pretty staggering pace, so they'll need to definitely watch their backs. Not a major concern, but something worth noting. A big headline that Amazon made was partnering up with a company called Anthropic. They are an AI research and development company. It's Amazon's equivalent to Microsoft's OpenAI. It's too early to say what will come out of the AI boom, but it's pretty obvious GPU makers like Nvidia and cloud providers like Amazon and Microsoft will definitely benefit the most out of this. An interesting little note that Amazon added on the call is that Prime Video will start getting ads starting in early 2024. Which is definitely a strategic departure from Amazon, who previously basically just kept stacking different perks onto the Prime membership. It seems like now they're going to take a look at all the benefits of Prime memberships and see which ones are actually helping them get members and keep members, and which ones should probably be spun off or canceled. So to all Amazon Prime members, in the future you either pay more, which is likely anyway, and you may see certain services become their own standalone products. And the last, but most important, at least from my point of view, is Amazon's advertising segment is up 25% year over year. And while it is still currently one of the smaller segments of Amazon's empire, but as we'll see with the likes of Google and Meta when we get into them, advertising is not only extremely profitable, but extremely scalable. And Amazon definitely has the number of users and the direct ability to buy products instantly. So they have a great potential to link advertisements directly with an immediate purchase, something that Meta and Google has always struggled with their ads. If you haven't noticed, both Facebook and Google have tried many years to open a kind of eBay, Amazon-like storefront, and both have had some margin of success, but nothing on the scale that Amazon would be able to do. So if you're concerned what will be the major growth driver for Amazon going forward, it's likely going to be a combination of advertisements, coupled with and leveraging the vast amount of data they have on sales in the retail division. And as always, AWS backing up everything on the server side. And to take a quick look at the numbers, as you can see here, over the last 5 years, Amazon is up 70% and is currently hovering around $138. This gives them a market cap of about $1.4 trillion and a price to earnings of about 52x. Next up, we have Google, the number 1 in advertising and the number 3 in the cloud race. They had a pretty standard earnings report overall, with a revenue growth rate of 11%, which is about equal to the growth of Amazon. Their cloud revenue did increase 22%, which is good to see. That being said, it did not live up to the growth rates that investors were hoping to see. And I do believe that Google has its work cut out for it. Microsoft is growing fast and Amazon is the current king. They have a lot of catching up to do. But as long as they continuously outgrow those two companies, it shouldn't be a major concern. Being a very distant third place contender, it gives them a lot of room for growth. And additionally, Google was a pretty late entry into the cloud space. So while they have a lot of room to grow, they also have a lot to prove. Hopefully they can foster an ecosystem that developers like to use. That'll determine whether they grow in the future. YouTube ad revenue is up 12%, which is about the same as the company overall. And they also mentioned that YouTube Shorts is averaging about 70 billion daily views by about 2 billion users. However, they didn't really say how that's going to translate into either advertisements or revenue moving forward. But I guess it's good to see them expanding YouTube's offerings. As you can see, over the last 5 years, Google is up 150%, and their share price is hovering around $130 right now, just shy of their late 2021 highs, a near complete recovery. At the current price, that gives Google a market cap of about $1.6 trillion, and a price to earnings just shy of 23x. Next up, we have Meta, or Facebook. I can still never decide which name to use. Forgive me when I flip-flop them constantly. But Meta had revenue up 21% currency adjusted year over year, which is fantastic growth, proving that Meta is still the king of social media and social media advertising. Unfortunately for Mr. Musk. And it's good to see that they were able to keep a lot of the revenue from the lockdown era. More importantly, operating income is back up to 41%. This is a return of profitability to the pre-metaverse spending. And while Meta is still honestly spending way too much in R&D in my opinion, at least they are finally calming it down until they maybe have a viable product. Because Meta really shouldn't have that much spending on R&D. They don't have a lot of things that they have to develop. They don't make hardware devices like Apple. They don't design chips like Apple. They don't design cloud infrastructure like Microsoft or Google. And they don't build warehouses like Amazon. However, they do make Ray-Bans glasses, so there's always that. What would we do if Mark wasn't pioneering the future for all of us? But Meta is a fantastically profitable company, and that makes it a pretty sound investment for the most part, if you can handle the CEO's occasional moonshot idea that dies out in a few years. The most disappointing part of this call was that they barely mentioned Threads at all. You know, the emerging social media platform that they should actually be developing a lot for, where they should actually be spending most of their research and development, which may also be the first product they actually designed in-house that could succeed. But no, never mind that, we all need Ray-Bans. Oh yeah, and the Quest 3 headset came out if anybody cares. But thanks to that tremendous profitability, Meta has regained most of its losses over the last 2 years. As you can see, over the last 5 years, Meta is up 111% and is currently hovering around $314 per share. That gives Meta a market cap of just over $800 billion. Feels funny saying billions and not trillions. And lastly, Meta's PE ratio is hovering around 22x. And the last company that just had its earnings that I'm going over today, and returning us into the $1 trillion club, is Microsoft. Because all the tech companies like to copy each other, they had a similar growth rate of their revenue of 12%. So despite the extraordinary market valuations of all of them, big tech can still grow. Microsoft's operating income is up to 47.6% of revenue, which is pretty astounding. That's a great profit margin to be running the company off of, especially considering that Microsoft probably has the stickiest revenue of any of the big tech companies, not having to worry about trivial things like market downturns that generally affect advertising and consumer spending, making Microsoft the king of recurring revenue. And one of the biggest contributors to both the profitability and the revenue growth is unsurprisingly their cloud revenue, up 24% to $31 billion in the last quarter. Which is incredible being that they're already the number 2 player, and far larger than the likes of Google, who had a slower growth rate of 22%, revealing that Microsoft can definitely flex its power in the corporate world. While the general consumer sees Microsoft as kind of ancient and backwards, in the corporate and government sectors, Microsoft is always the go-to. And because of all their software offerings, the stronger Microsoft's cloud becomes, the stronger all of their recurring subscriptions from corporations will become. Unlike Google, whose cloud division won't be able to really generate ad revenue to go with it. They're pretty separate industries, while Microsoft's other offerings have a lot of symbiotic relationships with cloud. Oh yeah, and a little not so important side note, Microsoft's acquisition of Activision Blizzard King has gone through. That was incredibly difficult to say. I hope you all appreciate it. Microsoft spent about $70 billion acquiring all these gaming assets to primarily boost their Game Pass, as they try to foster their cloud gaming division and gain even more subscription revenue, because there is never enough recurring revenue for Microsoft. Never! But all jokes aside, this makes Microsoft an absolute profit-making machine and a force to be reckoned with. This makes Microsoft basically the only company that has regained their all-time highs. As you can see over the last 5 years, they are up 228%, and their share price is currently hovering around $350, giving Microsoft a market cap of $2.6 trillion, and a price to earnings of around 31.5x. And that was the Big Tech Week. 4 major titans all releasing their earnings in the same week. Microsoft is an unrelenting profit-making machine. Meta, while still spending too much on research and development and paying way too much on stock-based compensation. Despite all that, it is still a highly profitable company, and we can only hope that Mark continues his focus on efficiency, if you're willing to take that risk. Google had strong revenue growth and is increasing its market share in the cloud industry. Like Meta, it also spends too much on stock-based compensation, and still needs to prove that it can not only keep up with Microsoft and Amazon in the cloud space, but that it can also gain market share. And Amazon has shown a strong performance despite the economic conditions, with its retail segment often feeling the impacts of market cycles, and despite already being the largest cloud company, can still deliver double-digit growth, while also delivering high growth in a very promising future advertisement business. So that was Big Tech. Let me know what you all think in the comments below. Did you see something I missed out on? And as always, if you like the content we make, please like, subscribe, and keep watching Interesting Investments.